Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here are some of the data points that we're watching most closely. The annual inflation rate has come down a lot over the past 2 years, but it is important to note we are still not close to the Federal Reserve's target inflation rate of 2%. The inflation rate is sticking at around 3.5% currently, and we believe it can stay at this level or even drift a bit higher for the rest of the year. Sticky inflation has put the Federal Reserve in a bind. They are lucky that the economy is not deteriorating yet, so they do not have to cut rates like everyone was projecting at the start of the year. But if inflation is still at 3 to 4% when rate cuts are needed, the risk is inflation accelerates higher and we must start the cycle of fighting inflation all over again. Because rates remain high, it means the interest rate on new auto loans and credit card balances is high too. That's a problem for consumers. The percentage of auto loans and credit card balances considered seriously delinquent is back to levels last seen in 2010 or 2011. If you remember, back in those years, it was not a thriving time in the economy. What is also concerning is the delinquency trend has not peaked and is instead continuing to go higher with each quarterly update. Over the past year, we talked about the excess savings that consumers had from the government stimulus that was provided during the pandemic. The San Francisco Fed just updated its estimate and suggests that that excess savings is now completely gone. This does not mean consumers are going to stop spending. They can still use credit cards to keep their spending afloat. But with inflation higher than desired, a low personal savings rate of 3%, and no excess savings, we think the average consumer is going to have a tougher time in the quarters to come. A final headwind for households is the employment trends continue to weaken. We like this look at employment from Investec Research that tries to weight the employment figures from the monthly ISM services and manufacturing surveys so it is in line with the higher percentage of U.S. workers that have services jobs instead of manufacturing jobs. A reading of 50 would be neutral. Below 50 is concerning. What we see is the trend has been downward since 2021 and been below 50 for months. The only 3 comparable scenarios of the past 30 years were all recessionary. With higher inflation and weaker trends for the consumer and employment, you would think investors are becoming more concerned in how they price assets. But a look at the corporate bond market suggests otherwise. You know that bond investors are fearful when the spread gets very wide between the yield for a junk or investment-grade corporate bond compared to the yield of a 10-year Treasury note. What we have today is the opposite. A junk bond is only yielding about 3 points more than a Treasury note, and an investment-grade bond is only yielding about 1 point more than a Treasury note. These are extremely low levels that do not compensate the investor for any market turbulence on the horizon. In the stock market, we see more individual stocks and industries falling in price. But the S&P 500 index price continues to hold up thanks to 4 big winners. Year to date, more than half of the gains in the S&P 500 are coming from 4 stocks: Nvidia, Amazon, Microsoft, and Meta. In fact, Nvidia on its own has contributed almost 40% of the total market return. It is great if you have owned some of these 4 winners, but it does not indicate a healthy market. All big winners peak and decline too. They are just the last to fall. We like to share reminders that the market moves in cycles and to not become locked into a specific style that's been working. This chart is a good example of that. For the past 20 years, low dividend growth stocks have outperformed high dividend value stocks by more than 1% per year. What you can see though is this chart moves in 10 to 20 year cycles. Previous times when low dividend stocks had such a fantastic 20-year run include the peak of the Nifty 50 in the late 1960s, as well as the peak of the dot-com bubble in March 2000. We are not suggesting you sell all the low dividend stocks in your portfolio. Instead, we think it is a good reminder to broaden the types of companies you own rather than hoping this great run for low dividend companies will continue for another 10 to 20 years. The last topic we want to discuss is the 60-40 portfolio that has been so popular for a quarter century and why it is time to rethink that approach. A big reason the balanced portfolio of 60% stocks and 40% bonds worked so well from 2001 to 2020 is the 2 assets were negatively correlated. When one went down, you could count on the other to go up a bit and minimize the total decline in the portfolio. However, for the past 3 years, the relationship has returned to what investors experienced from the 1970s through the 1990s. This current relationship is one where stocks and bonds move together in price. This is why the decline in 2022 was even more damaging for balanced portfolio investors than the 2008 financial crisis decline. When bonds go down at the same time as stocks, the balance is not there like before. Our founding partner, Ted Oakley, is suggesting a different approach with three primary components. First, short-term treasuries for current yield. Second, owning some reasonably priced, growing companies in the stock market for some growth. And third, owning real assets with exposure to the commodity market in case this higher inflation economy remains intact. We believe this three-part approach is a better one for the current economy that we expect to stay like this for the rest of the decade. Hopefully that gives you a sense of some key variables we're tracking, as well as how we're constructing portfolios for the current environment. If you have any questions, please contact us. We provide the information that we think is most valuable to investors. If you'd like to follow our work more closely, please subscribe to our YouTube channel.